Hello, swing traders. This video is neither a solicitation nor an offer to buy, sell stocks, options, futures, or any securities. The video and all contents are for educational and research purposes only. Please get the advice of a licensed financial advisor before investing your money in any financial instrument. Okay, right now we're looking at a chart of DOW, Dow Chemical, and what I'm going to do is show you how to use the exponential moving averages, the 20, 50, and 200 period, in line with the full stochastics. And this is the two major indicators that I use to getting into trades. And also there is a third one, which I'm going to go in on a later video. And that is support and resistance lines. And also I want to do many videos on chart patterns and things like that. But on this one, I'm going to show you for educational purposes how to use the exponential moving averages and the full stochastics together to get into a trade and go ahead and get out. And this is what I use when I'm swing trading. As we noticed, Dow Chemicals pulled back in September. Around the 1st of September, it pulled back to the 50 period moving average. And if you look at the first gray area, it pulled back to the 50 EMA. And if you look down the stochastics, the stochastics were oversold. It went down below the 20 mark, which is the bottom teal line. And once that red line crosses back above the 20 mark on the stochastics, and also if you look at the green candlestick, it started trading above the previous close. And once that stochastic starts coming back out of the oversold area, and you look at the stock and it's holding the 50 EMA, a bullish indication. And sure enough, we had a nice little run up, and then we had some consolidation in there. And if you also look, the stochastics get embedded in there, and that's what happens. Sometimes these stochastics will get embedded and it will just keep running up, but there we just kind of consolidated. And if you look at the second gray oval area, we had a nice pullback almost to the 50 period moving average. Not quite to it, but it was pretty close. And also the stochastics wasn't completely oversold. It got right down to the 20 mark. But then again, I possibly would have taken that trade again, just because stock pulled back to the 50 exponential moving average. Stochastics was pretty close to the oversold. Once we got a crossover, and look, the red line crosses back over, and then we had a nice little run up, and then it goes to the over the 80 mark, which is the overbought area, the top of the line on the full stochastics. And that's when I go ahead and start looking to take profits and scale out. Sometimes the stochastics will get embedded, and what I like to do is scale out of a trade. I might sell half of my position and then go ahead and put a stop loss on the other half, maybe to a previous low of that day. But we can talk about that in a later video about scaling out of positions and taking profits. But if you look at the last gray oval area, this is when it doesn't work all the time. And never think, nothing is foolproof in the market. There's not going to be an indicator where it's going to work 100% of the time. It just does not happen. And also these lagging indicators. And what I mean by lagging is it's not going to follow every second, every tick of the market. But if we look at the last gray area, the stochastics got down to the oversold, and it looked like it wanted to pop up above the 20 mark, which actually I think it did, but then it kind of pulled back again. I possibly would have taken that trade, and then that candlestick where it started to get embedded, I probably would have just gotten out of the position because it broke through the 50 period moving average, and then I would have waited. I would have gotten back in once the red line crossed back over and we started closing above the 50 period moving average, and we did. If you look at the third gray area, we had a nice little run up, and also one of those days we had a nice gap. We got oversold. I'm sorry, we got overbought again, and again you would scale it out. Now, this is how I use the two indicators, the exponential moving averages, the 20, 50, and 200, along with the full stochastics. I wait until we have a nice pullback. We hold a moving average. It could be the 20 to 50 or the 200 period moving average, and then I wait for the stochastics to get oversold, and then I wait for an indication that we have some buying pressure in the market. Stochastics come back up out of the oversold area, and I cannot stress enough, don't just into a trade because it's sold, because it could get embedded down in there and you could have a sell-off for 2, 3, 4, 5 trading days, or even longer. You always want to wait for confirmation that the pullback is going to reverse. So, and this is basically buy the dips and sell the reps, as the old saying goes. Well, till next time, have a good trading day, and see you next time.